Given the conversation that Leslie was just having, and also given what's happening with Lyft, talking about anxiety.
Yeah.
We were saying during the commercial break, I am anxious. How anxious are you?
Not at all.
Not at all.
Stocks go up and down. You can't look at things over 2-week periods.
And it's OPM.
So what do you think's happening here, though, on the Lyft side?
What do I think's happening? So I think finding these IPOs is all about like a supply-demand dynamic in the marketplace. If you look at something like a TME that went out in like December, it was like going out at like $13, $13.50 a share, went down to like 11. It's now like $18. I think it's very difficult to look at these for 2 weeks. Obviously, a lot of people who said they were long-term investors in Lyft at the IPO, because volumes have still been pretty darn high in this thing. I think it traded like 14 million shares yesterday on a 34 million share deal. 2 weeks in is a lot. So people are, this thing is being heavily traded in a consistent way. I'm surprised though it like went down on an Uber filing. Like everybody knew that was happening.
But who do you think these investors are that are trading the stock as rapidly as they are?
I think it's probably a lot of high-frequency trading firms.
Okay.
I think it's
and therefore,
hedge funds,
do you think this was there a mistake in terms of how the book was run by the underwriters of Lyft in terms of where they allocated these shares?
I think it's like next to impossible for some of these. You know, somebody can say, "Hey, I'm a long-term investor." They're a long-term investor until it breaks deal price. And then, like, all bets are off for a lot of these firms.
But do you look at Lyft, and I mean, it's trading, 37% below the high price that it struck the first day. That impacts Uber in terms of what price it sets, and that does impact.
Well, what I care about is what the price of Uber is like 12 months from now. Because we're locked up. So it actually, 6 to 12 month lockup. So we don't actually care.
I understand that, but I mean, even if you look out 12 months, I mean, if it trades very poorly at the start and it starts at a lower base, that impacts the price in 12 months, no? I mean, you're still looking at it. It can.
I mean, a million different. I'll put it this way: I think there's this thing. If you had told me 3 months ago, or if I'd sat out here and said Lyft is going to be worth close to $20 billion, 2 weeks after the IPO, everybody in this room would be like, "That's a great outcome."
Okay, let me ask you a different question. So Lyft's going to have its earnings soon. Obviously, Uber will come out.
Yep.
Do you think that the investor class, and I know it's hard to sort of paint it with a big with one brush, is saying to themselves, "I want to see Uber have more revenue, and I don't really care about the losses," right? Then that's the sort of key metric that people are going to look for. Mm-hmm. Or do they say, you know what, I actually care about all of these losses. I got to hope that they're still growing, but they got to be paring back these losses along the way. Otherwise, this isn't going to work for me. Because I think that question is so fundamental, not just to Lyft, but to Uber and, frankly, all of these unicorns that are going public right now.
I agree. No, I agree with that. Look, I think you're going to see companies, and this is just by pure speculation, companies like Uber and Lyft and some of these other big loss-making companies come and report. I mean, Lyft went public a day before the end of the quarter, so they clearly knew their numbers. I think you will see these companies beat on revenue and come in, with better than expected, earnings. I mean, they'll still be negative, but they won't be as negative as I think people probably guided for.
And just to put some statistics to that kind of psychology surrounding losses, last year, 81% of companies that went public did so with negative EPS. Right. The aftermarket performance on day one, on the debut, was 20% for companies without earnings, only 10% for companies with profitability.
I guess the larger question is about, to me right now, is not so much, I mean, part of it's how fast you're just growing on the revenue side, but the other issue is this paring back of losses that everybody talks about, and whether you need to pare back the losses or whether you just need to keep growing.
So if you keep growing, I think you're fine. If you are growing 15 or 20% a year and still losing huge amounts of money, I think that becomes a bigger issue. I mean, look at Tesla. Tesla has lost money for many, many years. Amazon obviously lost money for a huge amount of years. Obviously makes a ton of money now. But I think if you ask most investors...
Can I just make a comment about both of those companies? In both instances, there was always a model in which you could argue that the company could make money.
You can for Uber very easily.
What about for Lyft?
I think you can as well for both of them. Look,
what is that path to profit? What is that path? Because people are saying, what is the path to profitability for these companies?
So
what is it?
In the case of, let's start with Lyft, because in Uber there's multiple businesses, I think, that have different things. So in the case of Lyft, the best thing for both of these companies in terms of getting them profitable is to actually be public companies and have shareholders who care about them making money. Every time the five of us jump into an Uber, they make money. And so they are making money. I'm not going to talk about
let's go backwards.
Or
Every time that 5 people jump in a pool car.
They do not make money, correct. But if you're getting in your Uber X or your Uber Black, they are making money. Because they're not acquiring you as a customer. Think about a business like. I thought
that they subsidized these rides.
Some rides are obviously subsidized, but for like the customers that continue to, they're like active, normal customers, they are making money. From you as a consumer, they are making money.
Well, they said that their core platform contribution margin, which is essentially the profitability for their core businesses, which include Uber Eats.
Which include Uber Eats. By the way,
that's actually negative in the fourth quarter of 2018.
Uber Eats, they are definitely not making money on Uber Eats yet. But the core U.S. ride-sharing business, these companies' financials look a lot better than people would think.
In the U.S. or all over the world?
In the U.S. Okay. And there's obviously, I think Dara is a master chess player. You can see what he did at Expedia and did a bunch of M&A. You're going to see, this happened before he got there, China, then Southeast Asia, then Russia, the Kareem deal. You were going to see other deals. You were going to see other companies around the world, like this kind of M&A, continue in the space.
Okay.
I still didn't get the answer on what the path to profitability is.
Path to profitability is, one, public market investors, if they demand profits, will cause them to cut back subsidies, one. 2, raise pricing. If you pay 23,
raise prices.
I think you're going to see prices.
Lyft and Uber both raise prices because right now they're in a death match.
And they have, but they have been raising prices over time.
Okay.
They've raised them in San Francisco. If you pay $22 to get to LaGuardia from here, you'll pay $25. You won't pay $50. But you
don't think that right now people are arbitraging taxis versus Uber right now? So to me, what's interesting is if Uber really meaningfully raises its prices, or Lyft raises its prices in New York City, I'll put my hand out.
If they raise prices 10 to 15%, all that money goes directly to profit. There's zero.
It might be, but it'll be zero if I'm in a taxi.
McKinsey has run a ton of studies on the elasticity of demand versus pricing, and it's a lot more inelastic than you'd think.
Okay.